Module 7 deals with fraud and ethical behavior. These are the lecture topics that we will cover. We're going to talk about what are values and ethics, and we're going to look at different definitions of fraud, negligence, and give you some examples of fraud. We're going to talk about internal control, creating ethical behavior, and how do you handle an ethical behavior if you find it existing in your organization. And lastly, we're going to discuss the Sarbanes-Oxley Act. Values. Values are an individual's concept of relative worth, utility, and importance of ideals. Values shape ethics. Ethics, on the other hand, are a set of moral principles that drive the behavior of right or wrong. External sources of values are religious, philosophical, legal, professional, cultural. These are where we get our values, are from our exposure to these different organizations, functions, or philosophies. Internal sources of values involve the respect for an organization, conformity to principles, and performance measurement. The degrees of unethical behavior are broken down into three categories: fraud, gross negligence, and negligence. Fraud involves intentional and misleading acts resulting in a financial loss to another party through the act of supplying information. To prove somebody guilty of fraud is similar to having to prove somebody guilty of first-degree murder. First, you have to show there's intent. The person intended to defraud somebody. There had to be a financial loss to another party, and you did this through supplying information to the other party. So this is the most severe type of legal determination as far as misbehavior is concerned. Again, I want to stress the fact it's very difficult to prove. And you'll be reading some cases later on in your homework assignment for this module, and you'll be trying to pick out were they fraudulent or were they not fraudulent in their activities as managers. Negligence is broken down into two categories: negligence and gross negligence. Negligence itself is the failure to exercise a degree of professional care expected in the circumstances. It's a failure to use the reasonable and prudent approach that a normal person would do, and one should have known of the results of their acts. So let's look at a possible example of negligence. Let's say that you have an accountant prepare your tax return. You have assumed that they have actually added up the columns of figures and determined your tax correctly, which means that they probably should have double-checked the calculation. They should probably added up the figures on the tax returns twice. If they didn't do this, they're negligent in providing the professional services to you. Gross negligence, on the other hand, is intentional. So this is different from negligence. In negligence, there's no intent. In gross negligence, there is an intent to perform their duties in a reckless manner. And again, the individual assumes they know the results of the actions that they took and what was going to happen because they were wanton in the way they acted. Let's say you hired again somebody to do your tax return, and they prepared your tax return under the influence of alcohol or some type of drugs. This is gross negligence. They know that they're not mentally capable of preparing a tax return and calculating your tax, and that it's going to be wrong, very likely. So that's an example of a gross negligence. Now, you'll notice the difference between gross negligence and fraud is that there was not necessarily a financial loss that resulted in gross negligence. Where in fraud, there had to be a financial loss occur. There are two types of fraud: employee fraud and management fraud. Here's examples of employee fraud. The most common type of employee fraud is abuse of expense accounts. Somebody's cheating on the deductions they're putting on their expense account that they turn into the company to get reimbursed. They're stealing assets. And this could be something as simple as a pad of paper or stamps, or it could be something as substantial as cash or computers or things of that nature. Another type of employee fraud are kickbacks. This is where an individual receives monetary reimbursement for providing a favor to someone else wherein the company might suffer a loss. Quite often this happens in the area of purchasing. A purchasing agent has several options to buy some particular asset. Because vendor number 3 offers them 2 snowmobiles if they'll purchase from them, then the purchasing agent accepts the snowmobiles and selects vendor number 3. That is a type of kickback, and these are illegal. They're not correct. You should select the vendor that has the best product for the amount that you're going to pay for it. Lapping. This is another situation where the employee is stealing from the company, normally stealing checks or cash, and it involves the accounts receivable. You're an accounts receivable clerk. You have some checks come in from customers today that you should be posting to their accounts to give them credit for them. You're a little short on cash, so you take 2 of the checks and put them in your pocket. Ultimately, you're going to either deposit these checks in your own personal bank account or create a separate bank account to process them with the company name on it, to which you only have the access. Tomorrow, you get some more checks in from customers. So the checks you received today, you apply to yesterday's accounts. So what you're doing is you're misapplying checks to accounts, and every day perhaps pulling off some checks for your own personal use. So this is like a snowball. It gets bigger and bigger and bigger and bigger. And you're going to say, well, I don't understand why my customer wouldn't see this. Well, it could be that by the end of the month, when they receive their statement, maybe the individual has completely covered the amounts that they paid to the company. Or on the other hand, maybe the customer calls up and says, I don't see on my statement the payment that I made on the 26th of the last month. So when they call in, who do they ask to talk to? Accounts receivable. So who receives the call? You. And of course you'll make excuses and say, oh, I'm sorry, we're behind posting our cash. I'm sure you'll see them on your next statement. Have no fear, everything's just fine. Very, very common type of employee fraud. And the last is a transaction fraud, where you actually misstate something on the books intentionally, to which you are benefiting. Be very careful of expense accounts. Never, ever cheat on expense account. I've seen too many examples in my career where people have been fired because they cheated on expense accounts. And normally it happens not because someone caught the cheating at the time the expense account was submitted, but for some reason a manager or an employer wants to get rid of an individual, and they have to have reason. So one of the first places they look is, let's look at their expense accounts. Can we find something on an expense account where they cheated, and that will give us the foundation to discharge them for cause. There is a situation where the CEO of the Bank of America back in the early mid-1970s was not liked by certain members of the board of directors. By examining his expense accounts, they found a $25 item on expense account where he had fraudulently posted an item that was not correct. And based on that item, they discharged him. So be very, very careful about your expense accounts. Now, on the lapping situation, I'll talk a little bit more about that later on when we talk about vacations. Management fraud, misappropriation of assets. Management taking assets of the company and using them for their own. This would be having the company pay for personal trips, maybe paying for personal expenses, things that should not be paid for by the company. Kiting. Kiting is a very severe situation involving bank accounts. There's not a lot of examples of this, but they do occur. For example, here's what happens. You open 3 bank accounts, A, B, and C. Basically, you have no cash in any of those. You write a check on bank A and deposit it in bank B, which creates a bank balance, even though it's fraudulent. Then you write a check on account B and deposit in account C. And then you write an account on C and deposit in A. So you have a fictitious flow of cash going around in a circle when basically you have not put any cash in any of the bank accounts. Now, you might have cash in the bank accounts, but you still could be kiting to inflate the account balances. This is like musical chairs. Sooner or later, if this kiting is discovered, somebody's going to be caught holding the bag. Because what's going to happen is if Bank A returns the check to Bank C because they believe it's been kited, then Bank C is going to be short the money. And maybe they can return it to Bank B, but sooner or later, somebody is going to be out the amount of money that's been kited. There was a kiting situation here in the Treasure Valley a number of years ago involving the Farmers and Merchants Bank. There was a cattle rancher that was kiting checks between the U.S. Bank of Oregon and the Farmers and Merchants Bank. And finally, U.S. Bank of Oregon discovered what was happening, and they refused to deposit a check they returned a check coming from Farmers and Merchants. So Farmers and Merchants was left holding the bag. So they didn't have any funds to go back to recover their money. So they were out several $1 million. E.F. Hutton's managers back in the 1980s were rewarded for the cash balances they kept in their various bank accounts on an overnight basis. And so they would set up several bank accounts and then kite funds between the bank accounts to inflate them. They were being rewarded, and so it was their personal greed that did this. Eventually it was discovered, and basically it was one of the things that put E.F. Hutton out of business. Bribery. Normally bribery involves international transactions. So we're paying a bribe to get somebody to buy a product from us. So this is almost the opposite side of the kickback concept. Many countries in the world, bribery is very much accepted as a part of business. And there's some rules in place that make this a very criminal activity, and you can be prosecuted and put in jail if you actually pay a bribe, international business, and you're a domestic company. Misstated financial information. A lot of the frauds that you see in the cases you're going to be writing up in your homework involve this particular type of management fraud. Also, the fifth type, manipulations of assets and liabilities. So they're intentionally misstating financial information, overstating earnings, supposedly, and other types of maneuvers to increase their personal wealth in some way or another.